So this might be one of the most important videos you watch. I know I'm gonna ramble a little bit, I'm gonna go off, but you need to understand this, okay? This is going to be the most important, crucial time period in the next 6, 12, 18 months that our country has ever seen, okay? So I'm going to answer what's going on with the real estate market, probably where it's headed, what you should do if it's a good time for you to buy or sell. So first things first, I always get asked right now, what's the market doing? Oh my God, the market's crashing. Oh my God, I feel so bad that you're in real estate. First of all, the market's not crashing, okay? We're on track to do the exact same numbers as we did in 2019, and that was one of the best years we had in a decade. 2020 and 21, they're unicorn years. We have to obsolete them out because it wasn't normal. The pandemic wasn't normal, printing $14 trillion wasn't normal, having the lowest interest rates in the history of our country down to 2.65%, not normal, okay? Never been done before, ever. That's what caused the crazy market of going 20, 30, some markets even 50% year-over-year appreciation. In a 3-year period, some markets saw an 80% appreciation growth. That's ridiculous. That's not good. That's not healthy. But when you print $14 trillion, it's like playing Monopoly. Instead of starting with $1,000, we're going to start with $10,000. Well, everything can go more expensive. Okay? So that's first of all. Second of all, oh, it's like a 2008 crash. No, it's nothing like the 2008 crash. Here's a couple quick stats. 2008, there was less than $17 trillion in equity. 2020-22, we have $42 trillion in equity. 29 of that is tappable, meaning people could pull that out and still have 20% equity in their homes. That means we have more tappable equity than we did equity in people's homes. In 2008, less than 30% people own 50% of their homes or more. And actually a lot of people were maxed out, 90 to 100% equity. Some people even upside down. Come to 2022, over 60% of Americans own their homes outright, and less than 10% own less than 80% or 20%. They have 20% of equity in their home, less than 10% of people do. So majority of people have at least 20% of equity in their home, a better way to say it. And I'm gonna edit this video, so get with me, stick with me, I promise it'll be worth it. In 2008, 88% of people were on adjustable rate mortgages, meaning that as the rates went up, their mortgage went up, their payments went up, their interest went up. Right now, over 90% of people are in fixed rate mortgages, and 80% of them have a 3 to 5% mortgage rate. So as the rates are hitting 7, 8%, it doesn't matter to today's homeowner, they already own. They're in a fixed rate mortgage, it's not hurting them. 2008, when the market went up, that's what caused the crash of 2008. No equity. Interest rates were going like this, like they are now, but actually interest rates are going like this. Right now we're like this. But as those rates increased, people's payments increased and they doubled and tripled, and people couldn't afford it. They couldn't take money out. The economy was hurting. So that's what caused the crash. That's what caused all the foreclosures. And the fourth stat that's kind of a little headliner in there is, you used to be able to rent a 4-bedroom house for $1,800 in 2008. Now, 4-bedroom house rents for probably $32 to $35, depending on your market. So it's actually more expensive to rent right now than it is to be in a mortgage in most cases. Whereas before, when rates went up in 2008 and the mortgage payments went up to doubled and tripled, they could actually walk away and go find something cheaper to rent. Right now, you walk away, you're going to go pay more in rent, so it doesn't make any sense to walk away. Plus, you have all the equity in your home. So that's what's kind of the difference. The reason why they're spilling the narrative out there that the market is crashing is because they don't want you to buy. Okay, they printed $14 trillion. They gave a lot of it to big banks, corporations, hedge funds. They got a lot of the money, and they gave us $1,200 to $1,800, and oh my God, you're gonna be so happy. I lost my $100,000 job, but I'm happy that you gave me $1,200. Again, I don't know how people didn't revolt against it. So they printed a bunch of money. They made money super, super cheap in those 2 years. A lot of people overpaid for their homes, put $100,000 over the asking price. So now they're sitting in a spot where they can't move, can't sell, and they raised the interest rates, doubled, almost tripled what they were in the beginning of the year, to tripled what they were a year and a half ago, a year ago. So that right there is what their narrative is, although the statistics aren't saying that. Like in most markets, we're pretty much flatlining. Year over year appreciation in some markets is as high as 3.8%. There's one market that's up at 10%. A couple markets are, that were overinflated. People moved from other states that were a lot more wealthy. They overpaid for the homes. They drove the prices up. Maybe those are coming back down because people aren't moving right now. Interest rates are at a 30-year average. So they're right around 7%. They did drop back down. I think they're in the low 6s, high 5s right now. But the narrative's still being pushed. So no one's buying, except hedge funds, Wall Street, corporations, people like JP Morgan Chase investing $1 billion into single-family residence, BlackRock becoming a mega landlord by investing $50 billion, actually even going like Katie Homes and Lennar and telling them to build whole communities that they're going to turn into rentals. They're not even going to try to come on the market. Every house that one of these investors buys is never going to come on the market ever again, which is going to hurt us, okay? Within an 8-year period, we're on trajectory to be a renter's nation. Once we do that, houses won't come on the market like they used to, making the supply limited, making inventory smaller, making prices go up and appreciation go up. And when people die, these investors are going to pick up those homes before they really even come on the market or before buyers really have a chance. They're going to keep rates kind of, higher. My prediction is like keep them around 5 to 7%, so that way if the hedge funds do need to use money, they'll get the money, cheap money. So that's what's going on in the market. So I know everyone's scared to invest right now, everyone's scared to buy right now, but I'm telling you, if you don't buy in the next 6 to 12 months, you will be a forever renter. And that is not good for the market. The American dream is to own a home, and the reason why you want to own a home is because that's the way you truly build generational wealth. That's how you become rich in this country. You get appreciation, you get equity. You're going to be rent no matter what. One way or another, you're paying rent to you or to your landlord. But you might as well pay to yourself, and that way you're building up this equity and this appreciation. We've had an average of 3 to 5% appreciation over a 40-year period. It's going to go up. It's going to be more like 5 to 7%. Appreciation year over year. So my advice to you, if you're a renter, go buy. Right now you can be a buyer, you can get your closing costs paid, you can get your rates bought down, and rates will come back down. You'll be able to refinance, and more importantly, you'll stop paying the landlord's mortgage. If you're a seller, I truly don't believe that anyone should sell right now. I don't believe it's a good time to sell, okay? And I also kind of believe that it's never a good time to sell. I always believe that you should keep your real estate. You should find a way to take out equity out of your home, go put it in a down payment on another house, rent the first house out, and go buy the second house and live in the second house. Or stay in the second house and rent out, or stay in the first house and rent out the second house. The more homes you own is actually one of the main statistics of true wealth in this country. There's 3 stats of generational wealth in this country. First, how young were you when you bought your first home? Number 2, how many homes do you own? And number 3, have you found other ways of making passive income? So, a little bit long. Hope you guys got through it. If you want any advice, if you want to plan things out, you want to come up with a strategic plan how to build up generational wealth in real estate, how to protect the real estate you do have, how to transfer it over to your heirs the best way possible, hit me up, Corey Boldroff, the Real Estate Planner.